Good morning, ladies and gentlemen. Well, according to my calculations, we are somewhere in the 30s or low 40s, still indicating that equities are not in a position to start coming off substantially, and that the balance between bonds and equities here is quite balanced. Neither should be hugely favored. I want to do something slightly different this week and show you what the yield curve is saying and why actually this score is quite appropriate for the time being, and why this balance between equities and bonds exists. It might be a long time before we get a decisive move between equities and bonds, and I'd like to explain to you why. Before we go into the yield curve per se, as background, these two charts are very important. The 5-year forward inflation expectation rate, which is basically very stable around 2.25. We are basically at the same levels as we were this time last year, and this is counterintuitive. Why would we expect inflation to be at the same level as we expected it to be last year before inflation actually exploded to the upside? Well, because bond yields are so much higher, and therefore the bond yields going up are depressing inflation. It's not until this actually starts going much higher or much lower that we will get the big moves in bonds. The other chart is this one here, which is the 10-year break-even inflation rate, which you can see is actually very close to the lowest levels that we have seen for quite some time. If we go back in time, you will see that we are basically at the same levels as last year, in the middle of last year, but we are still way above the 2% to 1.5%, or let's call it 1.75%, that we were for many, many years. Let's go back in time, and you can see that basically we were going up and down around the 2% mark for many, many years. At the moment, we're still above it. What the Fed would like to see is a breakdown in this over the course of the next few months. But at the moment, it's just showing that we are stable around the 2.2 to 2.4%, and that is also because bonds are at much, much higher levels, and we are expecting inflation expectations, or the break-even inflation rate, to remain very stable. This has very important implications for the yield curve, and now I'll explain to you why. This is the 3-month minus the 10-year yield. And this chart caused quite a bit of confusion when I posted it. What is it showing? You can see the periods where just preceding recessions, and the start and the end of the recession is posted with these red lines. Basically what it's showing is that every time that the market gets below zero, it is anticipating recession, and just before recession hits, it goes back above zero. Now, why would that be? Very simply because the Fed controls almost completely the 3-month rate. If you expect Fed funds to remain stable at a certain level for the next 3 months, why would you lend 3 months below Fed funds? You just wouldn't. You just keep on rolling overnight and getting the extra yield. It's only when you think that you are very, very close to the Fed, i.e. within 3 months of the Fed slashing rates, that you would prefer to lend 3 months rather than overnight and rolling. So that is the very simple answer. And also, you must remember that the yield curve, the natural state of the yield curve, is positive. So if you think that the Fed is about to slash rates, and the only reason why it would slash rates is because the economy is going into recession, then you will start anticipating a positive yield curve. And the natural state of the yield curve is positive between 3 months and 10 years, roughly 170 basis points on average. So this is the average of the past X decades, and that is where you'd expect this to go back to once the Fed had started its cycle, its cutting cycle, and the yield curve returns to normal. This is the same chart, 3 month minus 10 years, but just the other way around. And there is no right or correct way to look at this spread. I prefer to look at it this way, but that's because I've been taught to look at it this way. And it just makes no difference. You can see that the most extreme was just below 100 basis points back in whatever this was, late 2000. And you can see that the tendency is for it to stay 1, 2, 3, 6 months, whatever it is. This is a monthly chart, don't forget, at these levels, waiting for the economy to actually start weakening, and then boom, very quickly within the space of 9 months to a year, it gets to the average level, which is around 170 basis points. That's because, as I explained, the natural state is for the yield curve to be positive, and the average positive is around 170 basis points. You can see how quickly it goes from the 80 basis points, negative or positive, whatever you want to call it, to 170 basis points, and that is a move of approximately 2.5%. So what it's showing you is that the cutting cycle is over 2.5%, because don't forget the 10 years will move as well, but they'll move on average about 200 to 250 basis points less than the very short end, because the Fed can only control the very short end, and the very short end needs to come down a lot more than 10-year notes to start supporting the economy again and get it out of recession. This is now a chart of the 2-year against the 3-year. And you can see that, the 2-year and the 3-year should be trading more or less on top of each other. Because really, what do we know what is going to happen between 2 years from now and 3 years from now in that 1-year period? We don't know very much. But what this chart is telling you is that the market is expecting a prolonged period of negativity in the yield curve, i.e. that the 2-year will be trading higher in yield than the 3-year. And if you look at now 2s, 5s, this is, don't forget, these are all monthly chart. This is the most negative we have been in, since God was a boy. We're trading 52 over between the 2-year and the 5-year. Indicate, and you saw that that email I posted, that really we're looking for something like 70, 80 basis point negative. That just shows you how much the market is convinced that at some stage the Fed has to cut. Now, how can we get to this level, call it 70, okay? How do we get to that level? Well, we know that the 2-year is going to basically trade on top or very, very close to what the terminal rate is going to be. So if at the moment the 2-year is trading, where is it, 450 something, then we are looking for the 2-year to get maybe another 20 basis points higher or 30 basis points higher, with the fives doing very, very little, i.e. the fives move maybe 10 basis points for every 30 basis points that the 2-year note moves. So we're looking for the 2-year note to come to these levels, which are between 475 and 499, where the terminal rate is expected. You saw even yesterday, Bostic came out with, what did he say? He basically said that he wants the terminal rate to be somewhere around 5%, whether it's 475 or 525, he doesn't really care. He wants to get there with a 50 and then a 25 and then maybe another 25. So whether it's 475 or 5%, he doesn't really care. And if Goldman are right and there's another 25 in May, which I would really argue with, they don't really care. The 25s are really not all that important, and that gives you a 2-year somewhere between 475 and 499, much like here. And then what happens to the 5-year note? Well, the 5-year note only backs up to here, which is 450. And that gives you that 70 basis points that we've been talking about in the 2s, 5s. Here we are, and that gives you the 2s, 5s up here. Now, this is very unstable. What you have to realize that this is hugely unstable as far as the yield curve is concerned. Can we get there? Absolutely. But what is that going to indicate to me? It's going to indicate that at some stage the economy gives up. Now, whether that is going to be Q1 or Q2 or Q3, we don't know. And that is what the 2s, 3s are telling you. People are preferring the 3s because they are much more confident that it's going to happen during the lifetime of the 3s as opposed to the lifetime of the 2s. Now, how can they possibly know that? They have no clue, right? But what they're saying is that they are prepared to give up 20 basis points over the course of 3 years for the added safety of knowing that it's going to happen. Now, could the 2s, 3s do something like here? And look, when that happened basically 99, and they were right, because the Fed didn't start cutting till basically late 2000, right? So let's have a look at the 3 months here. When did the Fed start cutting? Started cutting here, November 2000. But when it started cutting, it went boom, right? It went from 260 down to, let's call it 100 basis points. So best part of 200 basis points. And that is what the 2s, 3s are indicating to you, that the market does not know when that is going to happen, when the cutting cycle starts, but it's more than willing to give up 20 basis points over the course of 3 years, or 1 year, 2 years, 3 years, to make sure that it catches it. And also here that it's prepared to give up 50 basis points over the course of 3 years to make sure that it catches it. To me, this is the market not knowing where the cutting cycle starts, but being absolutely convinced that when the cutting cycle starts, we are going to go to at least down here. and prepared to give up some yield now in order to be able to catch this move all the way down to here. These now are the 2s 10s, and as you can see, we are just powering ahead. I would not be surprised to see 100 now. But what does that tell you? That tells you that the 10s are going to be relatively stable while the move is in the 2s. And back to what I showed you, I would not be surprised to see the 2s 30, 40 higher. But if we get this move all via 2s and the 10s, and these are the 10s, now just stay here, that tells you that the 10s are going to be stable to bid, while everything in the yield curve moves in the 2s. That is that higher for longer that the market is trying to price in. And it's something which can only be temporary, because when the recession strikes, and the market basically with this yield curve is telling you that it's absolutely convinced that recession will strike. Why? Because if it weren't, it would not be pricing in 2s 3s and 2s 5s where it is and looking for worse prices. It's saying that sometime over the course of the next I don't know what market is saying, we're going to get a very bad recession, and I am willing to give up yield to be able to catch it. So to me, the 10s and the 30s are now going to be quite stable. The give up is going to be mostly in the 2s, is going to be mostly in the 2s to 5 area, and the 10s and the 30s are going to be fairly stable, because if the market is absolutely convinced that recession is going to strike over the period of it doesn't know what, then certainly nobody is going to be a very large seller of 30s, because it just wouldn't make sense. So back to these charts. If you expect this to be right, and i.e. that the 10-year break-even inflation rate is going to be around, let's call it 2.3, 2.4, you're really not going to be a very aggressive seller of 10s at the current yield, or 30s for that matter. That to me all indicates that the market is expecting the following: no wage acceleration that accelerates inflation. At some stage over the course of the next it doesn't know what, a recession, and then the Fed, far from keeping rates stable for a very long time at, let's call it the terminal rate, let's call it 5% for the sake of argument, is going to have to slash rates at the speed of light. I have never seen a market which waits for the Fed for years and years and years. That, to me, is unlikely to happen. The Fed is going to have to start slashing rates as soon as the economy hits the buffers, because when the economy hits the buffers, it's going to be a very bad one, because real rates are now going to be so high. If inflation next year starts coming down very fast, which is what these charts are predicting, right? These charts would not be at 2.2 if inflation was going to be, if the market thought that the inflation is going to be very sticky above 4%. Now, could it turn out that it is? Absolutely. But then this will start moving higher, and we will have our warning signals from this chart. At the moment, we're not getting them from this chart, and that to me says that it's unlikely that we get large moves in the 10s and 30s over the short term. This is a chart of the 30s, and you can see what I mean. I think it's unlikely that we back up much more than 405%. And basically we do something like here. We stay in a tight range for quite some time. The long end seems to have discounted very much all it's going to discount for quite some time, and it's relying on the short end to keep those inflation expectations in check. And it's saying the Fed is going to succeed, and the only question that remains in the market's mind for the time being is when recession will strike and when all those spreads will reverse and when the yield curve goes positive. To me, the 30s are now going to be dead and trade in a 20-30 basis point range for quite some time. And if we go to the 10s, much the same kind of thing. You're looking for the 10s to back up to 399 at most, this kind of area, and do something like here, for a few weeks, going absolutely nowhere until year end, and basically be dead and rely on the 2-year notes to steepen the curve. The obvious implication of what I've been saying is that the MOVE index, and this is the MOVE index, the only place I could find it really was on Yahoo Finance, should now start moving lower, and it should start coming below 100. The only time that the MOVE index will spike again will be like here, when the yield curve is about to flip again to positive, and then you will get buyers of calls in everything that has a, that is a bond. For the time being, because 10s and 30s are going to be anchored, and even the move in 2s, because we're quite close really to the terminal rate, 30, 40 basis points is really not going to be that important to it. It should mean that this starts coming down to at least these levels here, just below 100. What does that really mean? It means that the only time you're going to get volatility or volatility getting bid up is when there are some important numbers coming out. Something like CPI or unemployment numbers, or things that indicate where the real economy is at. Any period between two numbers is going to be very, very quiet, because the Fed can only start judging the precise terminal rate, and when it stops the hiking cycle, and if it stops the hiking cycle, when it gets data. So to me, the easiest way to make money in this environment is to stay away from the very short end, the 2s, and really sell straddles, very short-term straddles in the 10s and 30s in the periods between data. We have the Wednesday options and we have the Friday options. And as I look at the economic calendar, I'll tweet to you what the best straddle is to sell for the very, very short term, 3 days, 5 days, to take advantage of this high volatility that is implied by the MOVE index, which should move lower as well, and the theta, and the fact that we've ascertained that the 10s and 30s are probably not going to go very far at all, and that all the pressure is going to be in the short end. And to sum it all up, here's a pictorial representation of what I've been saying. Current a week ago, 2s are up by 16 basis points, Threes are very much on top of where they were. Fives are, what's that? 5 basis points. Tens unchanged. 30s are actually 10 basis points lower than they were. So as you can see, all the pressure is in the twos. 30s are doing their own thing, and this part of the yield curve between the twos and the tens is slowly giving up, but most of the give up in the twos, and these are going to move a quarter or whatever that move there is. It's quite possible that next week that move there is only 5 basis points, 10 basis points, in which case you'd expect the fives to be almost unchanged. A couple of basis points here or there. And you'd expect the tens very much to be, only a couple of basis points different as well. So this is the area that you want to start selling the volatility, the straddles, and leaving that alone to, get to the 480s or whatever it is that it will. But what this is saying is that you can't really expect, if there's pressure here, these are really not going to do much better. And every time there's a rally in them, you sell them, or at the very least you sell calls. So this is our strategy for next week. Very clear. You let this back up. You let it drag these with it, much less, but they will go because they have negative funding, and there's no reason really to be into them heavy. And basically you just sell straddles because they're not going to go too far. If you look at the German curve, much the same thing. These are the twos, least bullish. They're coming off the least. If you look at the fives, a little bit of a turn. If you look at the tens, more of a turn, but still very much trading within a predetermined range. The tens in OATs, which are the clearest chart, are still refusing to break this very important level around 248, but they're not going very far, are they? I would expect that when they do break 248, you're looking for something like this. You're looking for 217, i.e., 25, 30 basis points better. But that just means that the yield curve is still going up. Okay, so these are the twos, fives. Let's go to a monthly view so you can see how, you can see that they are just about the worst levels they've been for a long time. Twos, tens would be actually more interesting. And as you can see, they're breaking some very important levels. And what they're saying is that from these levels of around 10 basis points, they could easily get to these levels quite soon of 30 basis points. Maybe the twos do nothing and the tens do slightly better, right? So that would make some sense. But you can see that in both the US and in Germany, the pressure is all at the short end and very little pressure at the long end. If you look at this chart of the tens, could we easily come back down to these levels? And let's enlarge that, around 180. Yes, absolutely. It's unlikely that there is that much pressure on the long ends of either the US or Germany. And if therefore we go to a cross US-Germany and we go twos, you see that is quite stable and it keeps on coming back towards that 255 level and not going anywhere. Let's go to a daily. It just in a range. Yeah, it's in a 10-15 basis point range. And the most interesting, tens, what this says to me is that every time he gets to these 190s and 196, I particularly like as a level, It's an almost automatic sell. If we go to the monthly on that, you can see that it's very, very likely to remain in this range for quite some time. The time it'll break down, thinking about it logically, is when recession hits in the US. And that is when it'll start breaking this very important 152 level. In the meantime, every time it goes up towards this 196 level, to me, it's an automatic sell. I just can't see that this has any danger of going below, beyond 2. To me, it's an automatic sell at 196. And finally, these are levels that you should have marked around the 216 differential in 30s, again, US against Germany. To me, that is an even better thing to sell than the 10s around the 196 area. I think this is even more likely to come down. And if I change that to a daily, you see we have a chance of getting up there again over the course of the next couple of weeks. If we see it, that is an excellent risk-reward level to get short of German 30s against US 30s. Just an absolutely fantastic level. As you can see, I have a reminder on there, and I will definitely tweet it to you. Well, the dollar basically stopped where it should have done, i.e. around that 106.25 level. I didn't play it at all last week simply because it was so uncertain. I would love to see it at 109, just short of 109 or whatever. I think the risk reward there is actually to go short again. As you can see, it's bounced very nicely off the 200-day moving average, or it didn't even test it. It's likely now to remain in a range, something like here. I think the risk reward around the 109 area, for it to come down. And if we have a look at Euro USD, it got beautifully to these levels. I got out everything I had. I'm not playing at these levels. I'd much rather play way above or way below. Here, I just don't know what to do. The risk reward is like 0. And that same risk reward of 0 applies to gold. Because when you think about it, what have I been saying? Volatility in the long end goes down. So 10s and 30s don't really move that much. No idea where the dollar is going to go. Is it going to go, a little bit better, a little bit worse? No real risk reward. We could not break 1764 on a closing basis. We came off it. And really, what is the risk reward in gold? Very little. We are still below all the weekly moving averages. The Bollinger Bands on the weeklies are coming down. We know that 1810 to 1830 is going to be a huge resistance. So what do? Well, really, you wait for the market at least to come down to 1710 to have some kind of risk reward, right? If you want to be long. And otherwise, you completely leave this alone. There's very, very little in it at the moment that is a certainty. If you look on the dailies, we got overbought. Can we go now back down to 1710? Quite easily, I think. Right? Quite easily, we can go back down to 1710 as the bonds and the Dixie basically do nothing to slightly worse. And then that might be some risk reward, but at the moment I really don't see that there is any. DBC, I mean, these levels are now set in stone, aren't they? 24.39, 26.93 as the swing level. Until and unless we break one of those, there's very little to do in here. What is interesting is, the chart against gold. I mean, this is 638 is such an important level. I prefer gold here, and I think gold is going to do nothing. And therefore, I have to believe that DBC is going to do much of a muchness, and really not somewhere that that the spreads are saying that the timing is now to get involved. Just leave it alone. Made enough money over the course of the year on this to not to have to play it now. To me, equities are now all about, this chart and the technical levels. Why? If the yield curve keeps on basically bear steepening, as I've showed you, there's very, very little odds that equities can do substantially better, because A, the timing of the recession is not now, but the market is expecting it at some stage. Therefore, who is really going to start paying much more than times 18 earnings, which are still probably very unrealistic? Every time there's a recession, and why would the yield curve be where it is if people are not expecting recession? Every time the recession strikes, the E comes off by about 30%. I mean, you can argue that it's 20%. So what? From expectations of around $230, slightly more or slightly less, even a 20% move gets it back down to the lows, at least, if not below the lows. So every time it gets anywhere near this times 18, which is, let's call it 41 something, you really want to be loading up on put spreads, because the yield curve is telling you that's going to happen. But it's also telling you that the downside at the moment is very limited, because there's no reason to expect the market to go, or rather for the recession to strike now, because otherwise the yield curve will start disinverting very quickly. And it's not doing that. It's still, it's still inverting. And therefore, there is no timing signal at the moment from the yield curve. And believe me, the yield curve will sniff out recession far earlier than the equity market will. So that basically leaves us looking for technical levels that might, where the market is getting overexcited. This is a monthly chart. To me, the level on a monthly basis is 41.81. I know that maybe that's unrealistic, and really, for the trend to remain a trend, you really have to close this month below 40.11 in SPX. Let's have a look on the weeklies. The problem with the weeklies is that every time we are above 39.43, we are in quite a large potential range, right? And that the top of that range is really not until 42.47 on the weeklies, and that 41.80 level that I showed you on the monthlies, which really coincides with the top of the times 18 Blue Angels. So there is quite a bit of possibility the next week we rally, and that is why I keep on saying, it's not the time to be short equities. There is absolutely zero impetus there. If the 30s are not going to do that much, or certainly they're not going to do that much worse, why would you be short of equities? It just really doesn't make a lot of sense to me. I'd much rather not play equities for the time being. What's a good level? Is this a good level? Yeah, it is. I might put, 41.60. that's what you're looking for to even start thinking about really going short. To me, the one chart which says that even the equity market is expecting a recession to hit at some stage is this one, SPY over XLY. Why would we be now at the worst levels just about that we've been all year unless we expected the consumer at some stage to throw in the towel? I mean, I know they say don't ever bet against the US consumer, but this chart is definitely betting against the US consumer. Why would we be here? It doesn't make any sense, right? Normally XLY, when it's strong, it tends to show that the market as a whole is doing better. And here you have the inverse of that. You have SPY over XLY inexorably going higher towards the worst levels. I mean, if you have a look at where this is late May of, was it 25th of May of this year? And where were we in INX on the 25th of May? Let me have a look at that. On the dailies, 25th of May. What the hell? Just a second. Give me a second. 25th of May, we were, well, right here at the same level that we are now, 39, 30, 40, 50. So when it did this, the market rallied, and now that it's doing this, it should be showing that we are approaching some kind of a top in the valuation of SPY. If I think the action in the stocks is going to be quite boring because the bonds are going to be quite boring, I would have thought the only thing that would make sense is if this is NDQ or SPY. If we get a move down for whatever reason to fill this gap, I think it makes far more sense that this will trade again this 29.90 level from here. I.e., if for whatever reason you get a bad day in NQ, which gets this spread to around here, it would be a good buy for this level, for a retest of this higher level. Because if the pressure goes off the long end and it trades very quietly, these retests of these lows are quite likely to get bought for a move back up here. And that's the only thing I really can see happening in that spread, because let's face it, it's still very negative. And if we have a look here, you're really looking, this is against the Dow Jones. You're looking, if we fill in this gap down here, you're looking for moves back up to here. But it's not looking bullish in the long term yet, is it? So you're just looking to, for a couple of percent if it comes back down here and tests these levels, and I'll tweet it to you. And you know what I'm going to say here. I would love for there to be a confluence between filling in this gap down to 2060 in SPX, in VIX vol, and the SPX being up here around this level of 40.77 or 41 something. Let's go and have a look on the monthly, 41.70, 80, something like that. High, let's go to this chart. Basically high 4,000s, low 4,000 and or high 4,100s. So basically in that 2.5% range between 40.77 and whatever this level is, 4200, let's call it. That kind of area with a confluence of the VIX hitting those 20 levels would really give me high confidence to do some longer term put spreads. And of course, I'll tweet it to you. I've updated these levels. I think very little happens next week, but you never know, so we'll have them in mind. Have a wonderful weekend, and I'll tweet you tomorrow.